In today's video, I'm talking about investing in bonds. You may be asking yourself, should I invest in bonds right now? I saw the headlines the other day that said that the Fed is not expected to raise interest rates until 2023. That's 2 years from now. So it seems crazy to think that investing in bonds is a good way to go considering how low rates are right now. But investing in bonds still makes a lot of sense, especially if you are close to retirement. Bonds provide income, they provide stability, and are an excellent way to cushion that side of the stock portfolio, the other side of the coin, and make sure that you have the right mix of stocks and bonds for you. So in today's video, I'm talking about how I'm investing my clients' bond portfolios in this really low interest rate environment and helping to give you some insight into how an advisor invests client money. I've been doing this now for about 13 years. I've bought and sold a lot of bonds. In my estimation, I've bought and sold over $100 million in client bonds. So I am experienced in doing this. I remember what it was like when rates were still higher prior to the financial crisis and things getting really ugly with that. And then rates dropped, and they've pretty much stayed low for the last 14 years or so, pretty much as long as I've been an advisor now. So it's a really interesting time to be investing in bonds. It seems like there's no good place to invest in bonds right now, but that is not the case. So first of all, I do believe bonds should be a perennial part of your portfolio. Reliability, stability, income, all considerations, important considerations for investing in bonds. And if you're retired, usually I recommend anywhere from 40% of your portfolio in bonds all the way up to 70% of your portfolio in bonds. That's a good mix to have for someone who's retired, and generally good guidelines to shoot for depending on your age and how conservative you want to be. All right, so let's get into it. So my favorite way to invest in bonds is the bond ladder. Now, in order to explain how this works, I want you to picture a ladder. So each year that I invest in bonds represents one rung on the ladder. So if I build a 5-year bond ladder for clients, each rung on that ladder, I have 5 rungs, each represents 1 year. I have an even dollar amount of money in each of those years or rungs on the ladder. So if I put $100,000 into a 5-year bond ladder for a client, I'm going to put $20,000 into next year, $20,000 in the year after that, and so on, and keep building each rung of that ladder. Now, what's going to happen with that is it provides this, again, stability, reliability. So I know what the income is going to look like, generally what the yield of that portfolio is going to be with that 5-year bond ladder. So it's predictable for someone who's retired, and I can provide a pretty good estimate and know what their income is going to be for a client who invests that way over the next year at least. And so every year a bond will mature. So when I set the bond ladder up initially, I'm only buying a 1-year bond with that first year. But a year from now, when that bond matures, I get to reinvest that, not in a 1-year bond, but I add another rung to the ladder and buy a 5-year bond with that money. So even if rates stay flat between now and next year, chances are I'm going to get a better income stream from that bond when I reinvest it, because I went from a 1-year bond to a 5-year bond. So incrementally over time, bond ladders tend to provide a higher stream of income. And if rates go up, they also allow you to reinvest as those bonds mature at higher and higher rates. Now, I think over the next 5 to 10 years, the likelihood is rates will be higher and they will go up. And so in a rising interest rate environment, or potentially rising interest rate environment, I think a bond ladder makes a lot of sense. All right, so right now, So right now I'm sticking with short-term, intermediate-term bonds, I really don't want to go out further than about 5 to 7 years when I invest in bond ladders for clients. So bond ETFs also is typically where I invest. I used to earlier in my career, up until about maybe 3-4 years ago, 5 years ago or so, I mostly invested in individual bonds from individual companies, usually high quality corporate investment grade bonds. However, there are bond ETFs now that allow you to build a bond ladder. You can buy bonds in specific years. Like I can buy a bond ETF of bonds that mature in 2022, where every single bond in that portfolio is going to invest next year. So you can buy a bond ladder. It provides diversification because there's usually like 100 to 200 or more bonds in each of those years. And I can get about the same amount of income that I could get buying individual bonds without the risk of owning a single issuer. So bond ladders, for that reason, they're the absolute foundation of my client's bond portfolio. But it's important to diversify into other areas as well. So if bond ladders are the core, there are some things that we do around the periphery to add value, add diversification, and hopefully enhance those returns over time. So I want to talk about a couple of those other areas. But before I get into that, if you're getting value from this video so far, please give it a thumbs up. Let me know that you like it. Leave a comment as well if you have questions. That way I know to make more of these if you like it. And of course, thumbs down too if you think it's garbage. That's okay. Okay, so to address the risk of inflation, I've also been adding TIPS to client portfolios. So TIPS stand for Treasury Inflation Protection Securities. These are actually treasury bonds issued by the US government that have an inflation component to them. So what they provide this protection against inflation. And if you've been listening to my podcast or watched previous videos, I have talked about inflation. I do think it's a concern, not in the immediate right now, but inflation already seems to be like, it seems like it's picking up a little bit. And TIPS as a investment have actually been doing well simply because the inflation expectations are higher going forward. So it's the one area investing in bonds specifically that provide a protection against inflation because the price value of the bond will actually increase in an inflationary environment, which is usually the opposite of what other bonds tend to do. The other way that I'm investing in bonds is I will occasionally, not always though, occasionally add international diversification. So there's US bonds. It's actually the safest bond market to put your money in the world. Believe it or not, even given all of our debt, yes, it's true. But there are plenty of other countries around the world where there's a different interest rate environment, and it makes a lot of sense to invest in bonds and interest rate environments outside of the United States as well to capitalize on that. So international bonds are an important component, but usually a lesser component in most client portfolios. And to the best way that I think of investing in international bonds is to utilize high quality international bond funds. I'm usually not a big fan of bond funds in particular, but I think in the case of international investing, it's one of the best ways to get access to that because you're piggybacking on the research that a portfolio manager is doing to look at the various, there's currency issues, there's like exchange rates are different, that impacts the returns of the bonds. There's obviously the different interest rate markets, there's the geopolitical risk of that particular country region. It's complicated stuff, and there are experts out there who this is what they do all day long. And so I prefer to buy high quality bond funds if I'm going to invest in international, but I'm not a big fan in bond funds in general outside of that. So that's pretty much how I'm investing in bonds right now, even in this low interest rate environment. Yes, there's still value to be had in bonds. Yes, it should still be a perennial part of your investment portfolio, especially if you are getting close to retirement. All right. So if you got value from this video, please hit that like button. Tell me what you think. Leave a comment. And if you like this, you're interested in topics around retirement, you're planning for retirement in the next few years, be sure to check out my podcast, The 1 Minute Retirement Tip. You can listen to it on Amazon Alexa in your flash briefings or anywhere else you listen to podcasts. Links are in the description below this video. Thank you so much for watching. My name is Ashley Michike, and I hope you have a blessed day.